Welcome back to Smart Stock Sam, the channel where we cut through the noise and hand you the real picture before the market makes the move for you. And today, we are going inside the AI infrastructure sector, the physical backbone of the artificial intelligence revolution, to talk about four names that every serious investor is watching right now: Applied Digital, CoreWeave, IREN, and Nebius. Before you buy, before you sell, and especially before May 20th, you need to sit through every second of this video, because the setup unfolding right now is one of the most significant in this entire sector. Stick around, because by the end of this, you will have a clear tactical playbook, entry levels, targets, and a precise understanding of what could either make or break these stocks in the next 72 hours. Let me paint you a picture. The world's biggest technology companies, Meta, Microsoft, Nvidia, are writing multi-billion-dollar checks to secure AI computing capacity. They are not just shopping around. They are signing 15-year hyperscaler leases. They are locking in long-term cloud partnerships. They are betting their competitive futures on having enough data center firepower to run the next generation of artificial intelligence. And the companies building those data centers, laying the power lines, and filling the halls with GPUs, they are winning those contracts. Big wins, record-breaking wins. So here is the question that should be bouncing around inside your head right now. If these companies are winning so decisively, why are their stock charts looking like a ski slope pointed straight downhill? That is the core paradox of this sector right now, and it is precisely the kind of gap between perception and reality where generational money is either made or lost. We are in the middle of a violent repricing phase, and understanding it, truly understanding it, is the difference between panic selling at the bottom and positioning yourself for what could be one of the most powerful short squeeze and earnings-driven rallies of the year. So let us start from the top, because this is not just a stock-picking story. It is a structural story about how the world is rebuilding its digital intelligence from the ground up. Right now, the entire AI infrastructure sector is caught in a brutal tug-of-war. On one side, you have the long-term expansion thesis, the idea that AI compute demand is not slowing down, it is accelerating, and whoever controls the power-dense, GPU-loaded data center real estate is sitting on a gold mine. On the other side, you have the short-term volatility reality, balance sheets bleeding red ink, CapEx requirements that would make your head spin, dilutive capital raises, and insider selling patterns that raise uncomfortable questions. Take Applied Digital. It is sitting on what can only be described as a short-squeeze powder keg. CoreWeave is scaling revenue at a rate that would make the average software company weep with envy, and yet it is staring down a $24 billion debt wall. IREN is undergoing a full identity transformation, ripping out Bitcoin miners, installing GPUs, partnering with Nvidia, and pulling it off. And Nebius is posting margins so fat they look almost suspicious. Yet one executive decision has investors questioning everything. These are not broken stories. These are high-stakes growth companies operating at the absolute frontier of capital-intensive infrastructure, and the market is currently mispricing them because it is scared. And when the market is scared, opportunity knocks loudest. Now here is where we get to something critically important. To truly understand which of these companies will survive and thrive, and which might crack under the pressure, you cannot just look at revenue growth or contract announcements. You need to focus on two numbers that matter more than anything else in this specific industry: power capacity and the backlog-to-capex ratio. Think about power capacity as the moat. In the world of AI data centers, electricity is the new oil. You cannot run a GPU cluster without megawatts of reliable, cost-efficient power. If you cannot secure power agreements, you cannot build, you cannot operate, and you cannot deliver on your contracts. Full stop. The companies that have locked in power through long-term utility agreements, on-site generation, or co-location deals in power-rich geographies have an actual, defensible, real-world moat that is nearly impossible to replicate overnight. And the backlog-to-capex ratio? That is the revenue lock metric. It tells you how many dollars of future contracted revenue exist for every dollar the company is spending to build out its infrastructure today. A high ratio means the spending is justified, the customers are real, and the cash flows are coming. A low ratio means the company is essentially writing blank checks into the void and hoping the demand materializes before the balance sheet cracks. This is the single most important arbiter of long-term value in this entire sector, and most retail investors have never heard of it. So let us take those frameworks and run every one of these four companies through them, starting with the most polarizing name on the board. And before we do, let me ask you something that most financial media will never say out loud. What if the stocks that look the most broken right now are actually the ones the smartest money in the world is quietly loading up on? What if the bearish tape is not a warning sign, but an invitation? Keep that thought in your back pocket as we go through each company, because by the time we are done, you will have everything you need to answer it for yourself. Applied Digital. On May 18th, the stock dropped 8%, closing at $39.14. Traders were locking in profits after a massive rally fueled by the announcement of a 15-year hyperscaler lease worth $7.5 billion. 15 years, $7.5 billion. That is not a contract. That is a cornerstone of a business empire. And yet the stock dropped. But here is what the headline readers missed. The short interest on Applied Digital is currently sitting at 31.53%. That means over 80 million shares are being bet against this company right now. What does that mean in practice? If any meaningful positive catalyst hits, if Nvidia guidance comes in hot, if the next earnings print surprises to the upside, if even a single major institution upgrades the stock, you are not looking at a normal rally. You are looking at a violent, explosive short squeeze where the shorts are forced to buy back their positions at any price, driving the stock up in a self-reinforcing feedback loop. Now, we have to be honest about the red flags too. The CEO recently sold $6 million worth of shares, and Nvidia exited its entire equity position in the company. When smart money exits, you have to ask why. Does that mean the thesis is broken? Not necessarily, but it does mean the risk profile is asymmetric in both directions. The upside from a squeeze could be breathtaking. The downside, if the thesis cracks, could be equally brutal. This is a trader's stock right now, not a set-it-and-forget-it hold. From the squeeze play, we move to the scale play. And CoreWeave is in a category entirely its own. Revenue grew 112% year over year to over $2 billion. They have a contracted backlog approaching $100 billion. When was the last time you saw a company with a $100 billion contracted revenue pipeline? That is not growth. That is near certainty of future cash flows at a scale that most companies never achieve in their entire corporate lifetime. And yet, the market is terrified, and the terror has a very specific address: $24 billion of debt. In the first quarter alone, CoreWeave lost $740 million. When you are spending $30 to $35 billion on capital expenditures in a single calendar year, there is absolutely zero margin for error. The technicals are screaming caution. The stock is trading well below its 200-day moving average, and the options market has a put-to-call ratio of 2.40. That means for every person buying a call option and betting on upside, 2.4 people are buying puts and buying insurance against a further decline. The options market is not stupid. It is pricing in meaningful risk. But here is the contrarian question worth sitting with. What happens to a company with $100 billion in contracted backlog when it successfully refinances its debt at favorable terms? What happens when the capital markets stabilize and CoreWeave's cash generation starts to match its obligations? Does the stock look cheap at today's levels in that scenario? That is the bull case, and it is not a crazy one. Now, the pivot story of the year, and in a year full of corporate reinventions, IREN stands apart. IREN started life as a Bitcoin mining company, and rather than cling to that identity as crypto sentiment shifted, they made a bold and difficult decision: decommission the Bitcoin miners, install GPU racks, and reposition as an AI cloud infrastructure provider. That is not a pivot in the traditional business school sense. That is a full identity transplant. And it is working. They signed a $3.4 billion cloud deal with Nvidia. Think about what that means. Nvidia, the company whose chips power the entire AI revolution, chose IREN as a cloud partner. That is a massive vote of confidence in the management team's execution ability. But growth is expensive. IREN just closed a $3 billion convertible note offering. Convertible notes mean future dilution. Investors hate dilution with a passion, which is why the stock slid nearly 5% on the news. But here is the technical picture that gives the bulls reason for hope. IREN is the only stock in this entire group that is still trading above its 200-day moving average. And the chart is forming what technicians call a monthly bull flag, a consolidation pattern that historically resolves with a powerful breakout. The implied volatility is 120%, which tells you the options market is expecting a massive move in either direction very soon. What could that catalyst be? We will get there in just a moment. And then there is Nebius, the efficiency play, the margin machine, and perhaps the most complicated insider selling story in recent memory. Revenue is up nearly 8 times year over year. Their EBITDA margins expanded from 24% to 45% in a single quarter. They just secured a $27 billion agreement with Meta. By every fundamental metric, Nebius is firing on all cylinders. So why is the stock not screaming higher? 2 reasons. First, the valuation. At 77 times earnings, Nebius is not cheap. You are paying a significant premium for that growth and those margins, which means any disappointment, any guide down, any delay, any market rotation is going to hit the multiple hard and fast. Second, and far more troubling, the chief infrastructure officer recently sold $101 million worth of shares. $101 million, right after a blowout earnings report. Now, executives sell shares for all kinds of reasons: tax planning, diversification, personal financial needs. But when the person who literally oversees the building of your infrastructure walks out the door with a 9-figure stock sale, the market notices. And the market asks the question that every rational investor should be asking: what does that person know that we do not? The technicals on Nebius are neutral, not bearish, not bullish, just sitting there waiting for a direction. But that insider sale is a flashing yellow light that demands respect, regardless of how good the fundamental story looks on paper. Looking across all 4 names simultaneously, a striking pattern emerges. RSI, the Relative Strength Index, is in sell or neutral territory across the entire sector. MACD momentum signals are pointing south. Short interest is elevated everywhere. Applied Digital at 31%, CoreWeave and Nebius both above 20%. The market is making a collective bet against the AI infrastructure build-out. But now look at the other side of the ledger. Goldman Sachs increased its position in Applied Digital by 466% last quarter. Citi has a conviction buy on Nebius with a price target of $287. These are not momentum chasers. These are institutions with billion-dollar research teams that eat, breathe, and sleep financial modeling. So who is right, the shorts or the institutions? That conflict, that unresolved tension between institutional accumulation and market-wide bearish sentiment, is exactly why this sector is a powder keg right now, and the fuse is about to get lit. If you had to circle one date on your investing calendar for the rest of May, it would be May 20th, 2026. Nvidia earnings, not just important, sector-defining. Because every one of these 4 companies is so deeply embedded in Nvidia's ecosystem through cloud partnerships, GPU supply agreements, warrant arrangements, and technology integrations that whatever Nvidia says about AI factory demand, compute build-out timelines, and GPU delivery schedules will effectively reprice the entire AI infrastructure sector in a single after-hours session. If Nvidia raises guidance and says AI data center demand is accelerating faster than expected, the short sellers covering those 80 million Applied Digital shares alone could send the stock into orbit. If Nvidia disappoints or signals any slowdown in AI infrastructure spending, these names could see another leg down that tests previously unimaginable support levels. This is the ultimate binary event for the sector, and positioning before it requires both a clear thesis and an honest assessment of your own risk tolerance. For those looking at tactical setups heading into and through the Nvidia catalyst, here is how the levels stack up. For Applied Digital, the entry zone is between $38.50 and $39 even, with a target of $45 and Fibonacci support at $37.21. For CoreWeave, $98 is the critical hold level. Defend that, and a bounce to 110 is the play. IREN has a clean target of $60 if it maintains its 200-day moving average at $43.86, and Nebius, despite the insider cloud hanging overhead, has a tactical target of $220 with support at $192. These are pre-Nvidia setups, which means your risk management has to be sharp. Know your stops before you enter. Know your exit before the numbers hit. On the risk-reward matrix, each stock occupies a very different address. Applied Digital is your high-risk, high-reward trade. Maximum short interest, maximum squeeze potential, maximum downside if the thesis breaks. IREN sits in the balanced zone. Strong Nvidia backing, solid technicals, but capital-intensive execution risk. Nebius is actually the lower-risk name despite the stretched valuation. Those 45% EBITDA margins provide a real earnings cushion if multiples compress. And CoreWeave anchors the middle, enormous scale and backlog, but that debt load is a gravitational weight that could either be overcome or become overwhelming depending on execution. Now, before we wrap up, there is something important that needs to be said clearly and without ambiguity. Everything you have heard in this video is purely for educational and informational purposes. Nothing discussed here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. The stock market involves substantial risk of loss. Past performance is not indicative of future results. Always do your own thorough research. Consult with a licensed financial advisor who understands your personal situation, and never invest money you cannot afford to lose. The setups described in this video carry real significant risk, especially around a major binary catalyst like Nvidia earnings. Trade and invest responsibly. Here is where we land. The AI infrastructure sector is in the middle of a necessary, painful, and ultimately temporary repricing. The easy money phase of the AI trade, where everything with AI in the pitch deck went up, is over. We are now in the execution phase, where the market rewards companies that actually deliver on their power capacity build-outs, their backlog conversion, and their debt management. That is a harder game, but it is a fairer game. And in that game, the stocks that look the worst right now, the ones with the highest short interest, the most fearful options positioning, the deepest technical breakdowns, often become the biggest winners when the narrative flips. $40 billion in new contracts, 4 companies sitting in the red, and a single earnings report on May 20th that could change everything overnight. If that is not worth paying attention to, then nothing in this market is. And if you are wondering about Nvidia earnings, then better check out my detailed pre-analysis to give you full picture of what's coming ahead. Now I want to hear from you, and I mean that genuinely. Here is a question worth thinking hard about. If Nvidia beats estimates and raises guidance on May 20th, which of these 4 stocks, Applied Digital, CoreWeave, IREN, or Nebius, do you think sees the biggest single session move, and why? Drop your answer in the comments below. The smartest, most well-reasoned answer might just end up pinned at the top. If this breakdown gave you clarity, gave you an edge, or simply made you think about the sector differently, hit that like button right now. It genuinely helps this channel reach more investors who are trying to navigate this market with real information instead of noise. And if you are not subscribed yet, what are you waiting for? Smart Stock. Sam drops deep dives like this every single day. Subscribe and hit the bell so you never miss a setup. Finally, if this channel has ever helped you protect capital, identify an opportunity, or simply understand the market better, consider showing your support through YouTube's Super Thanks feature. Every contribution goes directly back into research, better production, and more content like this. This community is built on serious investors helping each other, and your support keeps this engine running. Until next time, stay disciplined, protect your capital, and I will see you in the next one.